Lecture 2, Asset Classes and Financial Instruments. In this lecture, we will introduce asset classes focusing on money market instruments, bonds, and stock indices. As you may recall, we talked about the top-down approach in the first lecture, and the top-down approach focuses on asset allocation before you do security selections. Asset allocation is determined by your investment horizon and your risk aversion. The longer the investment horizon, the lower is the risk aversion, and the more you can allocate to riskier assets such as stocks relative to bonds. In addition to stocks and bonds, we also consider other asset classes in the real world, such as commodity, including gold, private equity, real estate, and money market instruments. I encourage you to check out the videos below introducing rate values or weather portfolio. For money market instruments, we're going to talk about Treasury bills, but other money market instruments include bank CD, commercial papers, etc. For bonds and stocks, we're going to talk about Treasury bonds, Treasury notes, and stock indices. We will not cover other asset classes in this class, such as real estate, precious metals, derivative securities. Money market instruments are also called cash equivalents. This is because they have short-term maturity, they are marketable, and they are low risk. You can convert them into cash at really low cost and with high liquidity. We focus on Treasury bills. Treasury bills are the short-term debt sold at a discount, and they pay off the face value at maturity issued by U.S. Treasury. The discount rates are quoted rates, and they should be converted into bond equivalent yield in order to compare with other money market instruments or debt instruments. The income from Treasury bill, which is the difference between the price you purchase and the par value, is tax exempted from all state and local government, but they are not exempted from federal taxes. The denomination or the par value can range from $100 to $10,000 or more. And Treasury bills are issued nowadays twice a week. They have maturity of 4 weeks, 13 weeks, 26 weeks, or up to a year. Okay, so the maturity has to be below 1 year to be Treasury bill. Above 1 year, it becomes Treasury notes. When they quote Treasury bill, they quote the discounted discount rate annualized at 360 days. But in general, you need to understand what is ask price, bid price, and bid-ask spread. Okay, ask price is the price investor would pay in order to buy a Treasury bill from a securities dealer. Bid price is the price an investor would receive if she wanted to sell the Treasury bill to a dealer. Ask price is always greater than bid price, meaning that ask yield will be less than bid yield given the par value at maturity. Okay, and the difference between bid ask is the profit, source of profit for the dealer. Okay, when the dealers are quoting Treasury bill, they don't quote price per se. Instead, they quote using the bank discount method, which are quotes, meaning the percentage yields annualized using 360 days. On Wall Street Journal, this is the quotes you will see, okay? The first column indicates the maturity of the bill. The second column, meaning the bid discount rate, ask is the ask discount rate, ask quote, bid quote. And the change is the ask change from the day before. And the ask yield here refers to bond equivalent yield, which we are going to show how to convert the ask quote to ask yield in a moment. Okay. So when you see those numbers, they refer to, for instance, ask quote, they refer to the percentage yield discount rate annualized at 360-day year. For instance, when you see 2.0 on the ask, it refers to 2% discount from its face value, F, annualized to 360 days. So for a bill with date to maturity 90 days, to calculate the asking price, okay, we take the par value, the face value, times 1 minus the discount rate for 90 days. Since for 360 days, the discount rate is 2%, therefore, for 90 days, the discount will be a quarter of 2%, which is 0.5%. That leads to an asking price of $995 on the bill with par of $1,000. To calculate the bond equivalent yield, BEY, or the ask yield quoted on Wall Street Journal, we calculate the rate of return for the bond investors if she purchased the bill at the asking price and hold it to maturity receiving the face value. Then we annualize that rate of return to 365 days, okay? And for 90 days, we divide the return by 90 times 365 days, then bond equivalent yield is 2.04, okay? So the bond equivalent yield will indicate a more accurate assessment of the annualized rate of return on the bond investor. The exercise, you should try at home, have different date maturity, different bid quotes, and different ask quotes. When you want to convert the yield to bond equivalent yield, you always look at ask quote, because ask quote is the discount rate at which the investor can purchase the bill at. Okay. In this case, we show that 4.7 ask quote implies a purchase price of $976.50 on the bill with $1,000 par. And the asking price implies the bond equivalent yield annualized to 365 days will be higher than 4.7, which is, in this case, equal to 4.88%. Other money market instruments, I encourage you to check out the book, such as CD, Certificates of Deposit, time deposit issued by the bank, commercial paper, short-term debt, secured debt issued by large companies, euro dollar-denominated deposit in offshore banks. Brokers call individuals who use margin loans from brokers, and brokers have to borrow those loans from the bank. Okay, those are short-term money market securities commonly seen on the marketplace. Let's move to fixed income instruments on the capital market. Okay, those are the debt instruments. We are focusing on U.S. Treasury notes and bonds. Okay. Notes refers to Treasury debt with maturity 2 to 10 years. Bonds refers to Treasury debt with maturities over 10 years, and it can be as long as 40 years. For some of the foreign government, sometimes they issue debt at 100 years maturity. Okay, notes and bonds come with semi-annual interest payment or coupon payments. Okay, and the par value can be $1,000 or more. If you look at the quotes on Wall Street Journal for Treasury notes and bonds, it has maturity, it has coupon payment. So the coupon payment refers to the percentage of the par value that will be made in 2 payments of equal amount each year. Okay, for instance, 1 meaning 1%. So the coupon payment is 1% of the par in it's going to be paid in 2 equal payments, semi-annual payment. So each payment have 0.5% of the par. Okay. And bid and ask here for notes and bonds refer to the quoted percentage price of par. Okay, so now we're not saying 1 or 2. Instead, we're saying 99 and 100. It means that if you want to sell the bond or notes to the dealer, the price is 99.9922% of the par. If you want to purchase the same note or bond from the dealer, and you have to pay 100.0078% of the par. Okay, and similarly, the ask yield can be converted. The ask price can be converted into ask yield, accounting for coupon payments. It's worth mentioning that when notes and bonds are quoted, they don't quote in the continuous price increments. That's why you see the numbers 0.0078, 0.9922. You don't see anything that's very close to that number. The reason is there is a minimal size or minimal price increment in quoting bonds and notes. Okay. Nowadays, the minimal tick size is 1/108 of a point, or the percent, equivalent to a decimal version of 0.0078% of the par. Okay, so whenever the price change, it has to change as a multiple of 0.0078% of the par. Okay, for instance, on the trading floor, they don't quote the decimal version. Instead, they quote the price with a column followed by the multiples of the minimum tick size. On the trading floor, if you see a price 100 column 01, it refers to the decimal version of 100.0078% of the par. If you see a price of 99 column 14, it refers to 99.1094% of the par, because the 14 refers to 14 minimal tick size, which is 1/108 of a point. Conversely, we can convert the decimal points version on Wall Street Journal back to the trading floor quotes. Okay, when we see 99.8438, that means the trading floor quotes is 99 column of 108 minimal tick size. Okay. The way you do it is multiply the decimals by 128. Another example is the decimal version of quotes 97.2813. You can convert it to 97 column 36 minimal tick size, which will be the quotes on the trading floor. Okay, so I gave you a couple of exercises to try. In one, you want to convert the price on the trading floor because this investor is purchased. So you look at ask quotes, and 94.36 is equivalent to an asking price of $9,428.125 on the par of 10,000. Conversely, if you see a decimal version of 100.1406, it refers to 100.1406% of the par. And then you can convert that to 100 column 18 as the price quoted on the trading floor. Okay. Next, let's talk about municipal bonds, which is also called the munis. The munis are issued by the state or local government. Interest income is exempt from federal and usually exempt from state or local government, okay, local taxes. Okay, and this depends on the residence of investors. Usually the state munis or local munis issued by your own state or local government are tax exempted from local taxes. That refers to the tax exemption feature of the interest income, but the capital gains are taxable depending on its short-term or long-term. The long-term capital gain, the income tax or long-term capital gains tax may apply. Given the tax exemption feature of municipal bonds, it's very important to convert munis yield to bond equivalent yield or taxable equivalent yield, because bond equivalent yield refers to taxable bonds. Okay, so what you want to do is to take the munis yield divided by 1 minus the marginal tax rate for the investor in order to back out the taxable equivalent yield. Okay. For instance, if the munis yield is 2%, the investor has a marginal tax rate of 20%, then for the investor, a 2.5% taxable yield is equivalent to the 2% tax exempt yield because of the tax rate. Okay. Similarly, if the tax exempt yield, the munis yield, is 3%, marginal tax rate is 40%, then that's equivalent to taxable yield of 5%. For 5% tax munis yield, 50% tax rate is equivalent to 10% taxable yield. Okay, that's why municipal bonds are very attractive for high income and high net worth investors because of this tax exemption feature. Stocks, okay. Stocks are a very important asset class under capital market or long-term financial markets. Stocks are residual income, residual claim of the underlying cash flows of generated by real assets. Okay, they represent ownership share of a publicly held company or common stock. Okay, so common stockholders have the voting rights. It has the cash flow rights, meaning the rights to collect ordinary dividend payment. It represents limited liability. The most you can lose is the money you invest in common stocks. Preferred stocks have no voting rights, but it has cash flow rights. Usually preferred stockholders are paid fixed dividends, so it works like an infinite maturity bond or perpetuity, and it has priority over common stockholders in collecting dividends as well as collecting residual income. Okay. So corporations that invest in domestic corporations can exempt tax in the first 70% of the dividend. Okay. American depository receipt is another type of equity. It represents securities of a non-US company that's listed overseas. Okay, so if a Hong Kong company listed in Hong Kong, but they send some shares over the US market, let US investors to trade those shares are called American depository receipts. Okay, in Hong Kong, it's just regular common equity, but here it is ADR. For stocks, we want to focus on portfolios. The most important portfolios are stock indices. Okay. we have heard about Dow Jones Industrial Average. We have heard about SP 500 and NASDAQ, and they're all major stock market indices, and people look at every day. Okay. Stock market indices represent the performance of the stock market as a whole, with a little bit different focus depending on the construction of the index. It helps to track the average return of the stock market. It's used by portfolio managers as a benchmark to assess their performance. And also, its stock indices are used at the base to create index derivatives. Dow Jones Industrial Average refers to a 30 large blue chip companies are sort of average performance index. Okay, it started in 1896. It was calculated as the average price per share of all the 30 stocks included in the index. Okay, initially, over time, because each company has had stock split events, so the divisor 30 has been changed over time to adjust for stock splits. So that's why nowadays Dow Jones Industrial Average is close to 30,000. It doesn't mean the average price per share of the 30 company is 30,000, but that the average price per share in 1896 now has changed to increase to 30,000, accounting for stock split. Okay, so it measures sort of a return on the portfolio that holds one share of each stock at the beginning of the index creation. SP 500 is instead a market value weighted index. Market value refers to the market capitalization, which is the product of the price per share times the shares outstanding. Okay, so the higher the market value, the larger the company in terms of market cap, the higher the weight the company receives in the index. Okay, so it's broadly represent large firms because the 500 company included in SP 500 are large companies on the market. The index was created in 1957. For either index, you cannot invest in the index directly because they simply an index for us to track the performance. They're not directly investable. But investors can invest in index mutual funds or buy exchange-traded portfolios, exchange-traded funds that track those indices. Give an example of how price-weighted index is constructed. Suppose we have a two-stock portfolio. We want to construct a price in weighted index like Dow Jones Industrial Average. So we're going to invest in one share of each of the stock A and B in the basket. So when we initially construct the index, we're going to put in $125 buying one share of A and one share of B. So after the prices change, the basket is now worth $120 because we have two shares. So what we do to create the index is to set the initial value as the benchmark. Set it as 100, then we measure the subsequent value relative to the initial value to track the overall performance of the basket. Okay, so relative to 120, we look at 120 relative to initial value 125. 120 is 96 of the original value. So the index has dropped from 100 to $96, resulting in a negative 4% of rate of return on the index. Okay, so in this case, because we buy 1 share of each, therefore stocks with high price per share receives a higher weight. So we're putting 4 times of money in stock B than in stock A. When stock B drops while stock A price goes up, the index still loses money. Okay. I leave an exercise for you to practice, which has a similar setting, but you focus on date 0 to date 1. Look at how the index has changed, and also notice there's no change in outstanding, unlike date 2, in which case you have to do adjustment to the stock split. And the exercise shows that the index has a return of 4.55% from date 0 to date 1. For value-weighted index, we're going to use the same 2 stocks, A and B, to construct the value-weighted index. In this case, we're going to put more money on high market cap stocks. Market cap is calculated as price per share times shares outstanding. So we can create a hypothetical basket with all shares outstanding and each stock invested. Okay, so for stock A, we're putting 25 times 20, $500 or $500 million. Okay, for stock B, we're putting 100 times 1, $100 or $100 million. Okay, so the scale doesn't matter. So initially we're putting all together $500 in A, $100 in B, or $600. That will be our benchmark of 100. Okay. At date 1, after share price change, our market value for A shares goes up to 600. The market value for B shares in our basket goes down to $90. So the basket is now worth $690. If we set the beginning of value of 600 as the benchmark 100 and 690 relative to 600 and represent 115, meaning the return on the index is 15%. Okay, so in this case, while stock B price is dropping and stock A goes up because stock A has higher market cap, so we're putting in 5 times of money in A relative to B, and so the index is increasing because of A shares is increasing. So because A has a higher weight. Okay, so that's the difference between price-weighted versus value-weighted index. So price-weighted index gives more weight on high price per share stocks, and value-weighted index gives more weight to high market cap stocks. I leave an exercise for you to do, and the exercise shows that the return on the index is 0.525%. Again, you put in money that's proportional to the market cap of each of the 3 stocks to create your hypothetical portfolio. Lastly, we look at the equal weighted index. Again, using the same 2 stocks, A and B. The equal weighted index refers to a hypothetical portfolio with $1 invested in each stock. So you put in equal amount of money into each stocks. Therefore, at the beginning, we put in $2 in the basket, $1 in each stocks, which buys a fraction of shares that's inversely related to its price per share. Okay, and that fraction shares increased based on the price changes. Now the basket increased from $2 to $2.10. So if we set the initial value as 100, the current value is 105, meaning the return on the index is 5%. Okay. the exercise I leave to you shows that if we have a 3-stock portfolio, we're putting equal weight in each of the stocks, our portfolio will increase in value from $3 to 3.05 for $3, which represents a return of 1.81%. Lastly, I want to encourage you to read the JP Morgan Chase Guide to the Market Summary Reports. Okay, one of the pages of the reports, they show that a typical, the performance of 3 types of asset allocation portfolios. The dark blue represents 40% money investing stock and 60% money investing bonds. The light blue refers to 60%, 40% allocation between stocks and bonds. And the green one represents 100% in stocks invested in S&P 500. Over the last 13 years, you can see that during the financial crisis 2008 to 2009, the 100% stock S&P 500 performed the worst. Okay, so the more stocks you have, the worse the performance during the financial crisis. But after the over 10, 12 years bull market, S&P 500 has outperformed the other 2 portfolio with allocation to bonds. Okay, so stocks do better in market expansion in the market and do worse in the down market. Another interesting charts they put up there depicts the 20-year annualized returns by asset class from 1999 to 2018. Okay. We can see that over the last 20 years, as of 2018 December, REITs, which refers to the real estate investment trust that invest real estate portfolios, has the highest average annualized return at 9.9%. Gold at 7.7%, oil at 7%, SP at 5.6%, bonds at 4.5%, and your homes is 3.4%, all outweighs the inflation 2.2%. Which means if you put your money in any of those asset classes or combination of asset classes, you have successfully hedged your risk of inflation. Unfortunately, the last bar shows that the average investor's portfolio only yield 1.9%. Okay, so this is a big puzzle. Because investors can put money in any of the major asset classes, still beat the inflation rate, how come the average investor only earns 1.9% per year? Okay, it turned out to be the case that the average investor tends to sell low and buy high. Okay, so they tend to sell at the bottom of the panicked market and buy at the top of the market, which result in lower average returns. So if you are an average investor, if you don't have the skill or the time to beat the market, simply allocate your money across different asset classes and take a buy and hold strategy, because in that way you have outperformed the average investors on the market.